Hi, we're Wiser Wall Street, a team of high school educators making financial education accessible. Today, we'll cover a few essential market terms you'll likely be hearing during this post-election period. Let's jump right in. Market fundamentals. Market fundamentals are key figures that determine a company's value. They include revenue, earnings, growth potential, and debt. These factors show financial health and future prospects. Investors often value them more than short-term events like elections. Take Apple, for example. It has steady revenue, low debt, and high profits. This attracts long-term investors, even in tough times. Now, consider a small biotech company. Its stock is unpredictable, often spiking with news of potential drug approvals. Such news only briefly affects its price. In contrast, companies with solid fundamentals are more reliable investments. Interest rates and the Federal Reserve. Interest rates set by the Federal Reserve impact everyone's borrowing. The Fed adjusts these rates to control inflation and steer the economy. With lower rates, borrowing is cheaper, which boosts spending and growth. Higher rates hinder economic growth. For instance, in 2006, the Fed raised rates, causing a housing market crash. This crash then hurt the entire economy. Higher rates make loans pricier. They deter investment and expansion. This leads to slower growth and, in severe cases, a recession. When the Fed cuts rates, loans become cheaper. For example, a tech startup in Silicon Valley can easily borrow to grow. It might hire more staff and enhance products. This, in turn, creates jobs and boosts the economy. However, higher rates make borrowing expensive. This leads to less spending. For instance, high mortgage rates might delay home buying. Similarly, high credit card rates could stop big purchases. Thus, high interest rates slow the economy and reduce growth. Inflation. Inflation is when prices go up, making money less powerful. A bit of inflation often means the economy is growing, but too much inflation cuts into what people can buy and raises the cost of basic needs, like food and housing. For example, imagine grocery shopping and your bill came up to $100. Then a year later, the same groceries cost $105. Then one more year later, it cost $110 for the same few items. If this were really the case, that would mean there is an annual inflation rate of 4.76%. Initially, this seems minor, but over time, it quietly drains your budget. Suddenly, you have less money for fun activities like dining out, vacations, or hobbies with the family. To combat high inflation, the Federal Reserve raises interest rates. This action aims to reduce consumer spending and control prices, ensuring economic stability. It's a careful balance. Too high rates can hinder growth, while unchecked inflation can devalue money and create uncertainty. Bonds and bond market movements. Bonds are loans from investors to borrowers, usually governments or companies. When you buy a bond, you lend money for a set time. In return, the issuer pays you interest and returns your initial amount at maturity. Interest rate changes heavily influence the bond market. Typically, when interest rates rise, bond prices drop and yields increase. During uncertain times, investors often turn to bonds for stability. This is especially true in volatile stock markets. For example, during the 2008 financial crisis, many shifted to bonds to reduce risk and ensure steady income. In tough times, bonds' fixed payments are reassuring. These payments include regular interest and the return of principal. Bondholders know exactly what they'll receive and when. This certainty helps them plan better. In contrast, stocks are unpredictable. Their returns can fluctuate widely. Consider a treasury bond yielding 3%. It's better than new bonds offering only 2%. This demand raises the price of the 3% bond. Similarly, in unpredictable markets, investors seek the stability of bonds. Sector shifts. Sectors are groups of companies by industry, like technology, healthcare, or energy. They respond differently to economic and political changes influenced by policies, consumer habits, and inflation. For example, during a downturn, healthcare becomes more appealing as people seek essential services. Conversely, in a booming economy, consumer goods thrive, with people spending more on luxuries. The technology sector benefits from low taxes and interest rates, fostering growth and innovation. Low rates make borrowing cheaper, allowing firms to invest in new ideas. This leads to new products and services. However, high inflation shifts attention to sectors like materials or energy, where products gain value. For instance, Rising oil prices boost energy companies' profits. Investors can benefit from market trends by recognizing these shifts. Understanding sector responses to economic changes aids in making smart investment choices. For example, in high inflation periods, investing in energy companies is wise, as their value is likely to rise. Emerging markets. Emerging markets are rapidly growing economies, often influenced by U.S. interest rates and currency changes. A strong U.S. dollar makes it tough for these countries and their markets to handle dollar debt. When the U.S. raises interest rates, the dollar strengthens. This makes it tough for emerging markets to pay off loans, as they need more local currency to convert to dollars. Take Turkey and Mexico, for example. A stronger dollar increases their debt burdens, risking economic strain. In 2018, Turkey faced a crisis when the lira dropped, making debt much harder to manage. Investors eye emerging markets for growth, but should be wary of global economic risks. Understanding the impact of U.S. interest rates and currency changes helps in making safe investment decisions. Volatility. Volatility measures how quickly prices change in a market or security. High volatility means prices shift quickly. This can be good or bad. For instance, it offers bigger profits to risk-taking investors. On the other hand, it also means that there is a greater likelihood of losses. To illustrate this concept, let's take the example of an election. During election seasons, uncertainty reigns, causing volatility to spike. Market volatility sparks larger stock price swings, rattling some investors. Yet seasoned players stay focused on fundamentals. They ignore short-term ups and downs. They focus on a company's core strengths and long-term potential. This approach helps navigate turbulent markets with confidence and clarity. These include its revenue, management team, and market position, which are indicators of the company's long-term potential. Long-term investors especially gain from this strategy. They overlook short-term market changes. Instead, they focus on a company's core strengths. This makes navigating market ups and downs easier. For example, during volatile times, steady revenue shows a company's stability. Additionally, a strong management team helps to adapt to market changes, ensuring growth. By staying focused, long-term investors can endure market turbulence and enjoy the rewards. Practical advice. Sensational headlines can cause brief market shifts. However, fundamentals, interest rates, and inflation are the real drivers of the economy and stock market. Investors should focus on a company's financial health. They should not just follow trends or short-term reactions. Key metrics include its debt-to-equity ratio, profit margins, and cash flow, which are all great places to start. We've included a link to more key terms in the description below. If you found this breakdown helpful, subscribe to Wiser Wall Street for more stock market insights. And if you'd like to know how to evaluate a company to see whether it's worth investing in, then you can check out the video coming up right now. See you in the next one.